Welcome, welcome. This is Gull Khan, your money mindset expert. And once again, we have the beautiful, we have the amazing, we have the super smart Elisabeth Dawson. Welcome, Elisabeth.
Hi, how are you? It's great to be back.
Oh, it's a pleasure to have you again, Elisabeth. We had such an interesting conversation on Friday for each other. We had to have you back for Money Talkies. And today, just before we start, can you tell everyone briefly what it is that you do?
Well, I'm a financial advisor. I'm here in the United States. I work with individuals as a money coach and help them with the relationship to create more abundance in their wealth as they are working so hard to earn it. We want them to keep it as well.
Fantastic. And this is why I think you are the perfect person to have this conversation with. We are talking about today the importance of financial literacy for every single person. And by the way, we are talking about people, it doesn't matter if you are 15 or whether you are 50 or whether you're 65 or whether you're 95. It doesn't really matter. Every single person should, doesn't matter which point in life they're on, they need to start educating themselves about finances. So what's the first thing when you say financial literacy? I want people to understand what you mean by it. What do you understand? What was a layperson say? Okay, financial literacy, what does that mean? Do I need to know how much money is my bank account? What do you mean by that?
Well, it's a process, right? So, there's so many different ways to go through this. This is actually why I kind of created something fairly simple called my book, Wealth by Design. The main thing here is it's a step-by-step process. And I also created a financial planning course with it too on wealthbydesignbook.com, where you can get that and you can do your own planning. But financial literacy in itself is not taught in school. If you want to go for a finance degree, it's very different than the actual application to your personal life. That's looking at more of a corporate America, balance sheet. It's not looking at the individual, person to person balance sheet about where their cost, fees, and expenses go. So I like to bring up something called a lost opportunity cost. Any dollar that goes into something that you give away willingly and necessarily for the rest of your life, you lose that dollar. And also you lose the interest on that dollar. So sometimes we need to focus on the rate of return of what we can actually recover from our own expenses, not just the rate of return that we can actually earn from the stock market. And let me elaborate on that more, because when we go through and we do, let's say we kind of look at a cash flow analysis or a budget analysis, and most people don't even want to bring up the conversation about a budget.
Yes,
nobody wants restriction. They just want to go spend. They want to live their life. And they want to do things based on their own accord. Everyone should. However, there should be a dollar that we do that with. There should be a dollar that we do that with, and not the dollar that needs to be that foundation. I talk a lot about liquidity, use, and control, and that liquidity, use, and control will allow you to adapt to be able to make better decisions with, if you have this little money, this bucket of money over here, and that money can actually go for more speculation, great. If I've got this bucket of money over here and it's going to actually be there for my foundation, that's more important, just to be able to start that piece out. So when I talk about cash flow analysis and we kind of see everything, we spend so much money on things. Now, I know that this is a universal name, but Amazon, it's one of the expenses that we see a lot. Someone might be spending anywhere from $300 a month to $1,500 a month, or even $2,000 or $3,000 a month. But when, 5 years ago, if we had the same conversation, barely anyone was spending money on that. So what is going on? We are actually adapting to a higher immediate cash flow. Not that I have anything against Amazon. I use Amazon myself, but it kind of comes back even to some financial education about even the use of credit cards. I say, and I think I said at the end of our first interview, where, if I was talking to my 24-year-old self, I'd say, don't ever get into credit card debt, which, that's a choice. Most people will actually go into credit card debt and they'll say, okay, I'll just pay it off. We always have the good intentions. But when I was in my mid to late 20s, I literally remember myself at one point saying, oh, I want to get the bonus points or the mileage on my credit card so I can actually do a trip that I couldn't afford to do. And I would just put my mortgage payment on it. Oh my gosh, that was one of the worst things I could have ever done, because then that catapulted into the next month that it didn't get paid off, something else came up. So we have lost this foundation of having liquidity, use, and control to be able to actually accept opportunity. If we keep charging more and more on a credit card, and it just gets bigger and bigger and bigger each and every year because the cost of life gets bigger and bigger, or we have things that we want to enjoy that are bigger and bigger. Well, at what point is what's sacrificed? It's the ability to save money. So many years ago, that was the number one foundation, is to save money, have liquidity. We don't have that. And I think, offline, Gull, we were talking about, your investment structure, what you have felt has been strong for you has been real estate.
Mhm.
I think that goes across the board. Many people feel that their real estate positions have been, phenomenal, especially in this last 2 years. And, certain things will actually occur. And, I was a product of 2008, and I had gone through a divorce at that time. And it was very difficult because I did own a lot of pieces of real estate, but yet the market just went from here down to here. And then home prices have finally recovered again. But since 2008, so it's a very long period of time, almost 14 years.
Yeah.
But do we have that amount of time? Do we have the liquidity to be able to afford making those payments, especially during the pandemic, where people weren't even paying their rent, even if you had rental properties? And they had the permission slip for moratoriums through the government saying they didn't have to pay it. So how does that make you feel as an investor if you didn't have enough money to be able to afford to pay that? You could lose that property as fast as you gained it. So it's about creating redundancy and financial education, financial literacy. Every single time I talk with someone and someone engages with our services, we go back to this place and we say, well, how do you feel about what you've learned so far? And they say, well, why hasn't this ever been taught in school? I said, it's intentionally not taught in school because our societies want us to be very codependent on government and government resources. And unfortunately, when you are the number one person that's responsible for your financial outcome, whether it's today and you're working and you're thriving and you're building your business, or you're, a high wage earner for a corporation, I mean, it's no different because we all have similar goals. When we're younger, we're looking at how do we take care of our children? We have our partner in life. We have a home that we want to buy. Or we're living in, and we're trying to save for something called retirement that we have no idea what it looks like. And we're thinking it's so far away, I don't even have to think about it, but I want to live a little bit today. So I want people to make as much money as they possibly can. But at the end of the day, I want you to keep as much money of that, of those resources as you can. Because if you don't have what there is to show for it, then where was all the ingenuity and creativity and wealth that you've created? Where has it gone? So how can you hold on to the wealth that you've been able to create? Not just have it evaporated to the government in taxes, not just evaporate in lifestyle expenses, not just evaporate in places that don't necessarily protect you in the event that we might have a market correction. Could housing go down just like it did in 2008? Could it be worse? I was recently privileged to some information where, and I've Googled it and it's out there too, but there are more 90 to 120 day lates today on mortgages than there were prior to 2008. That's frightening. That's news that's being held from public audience to actually understand. If the stock market or, the global market start to decline, and they all kind of follow one another, right?
Yeah, they do.
And so as that starts to go down, and, then there's a new piece of on the environment too, cryptocurrencies, all those things start to go down. What is the redundancy? And I think I said this on our first call too, is, pigs get fed, hogs get slaughtered. We don't have to be greedy. We can create wealth without worrying about being greedy. We can actually, take it the way it is, look at it, give it a good common sense approach, and create that pyramid of financial planning, and just really create that foundation so that if all the speculative parts kind of go crazy, we're going to be just fine. It's not going to have an impact on our overall ability to live the life that we want and to be able to grow the wealth that we want to create for our future.
Agreed. I mean, I'm glad you mentioned this, and I don't know when people are listening to this podcast. Depending on, it will be released in a few weeks from the point of time we're recording it. But as we speak, I think in the US, the Feds are meant to be speaking on the Wednesday. We're talking on the Monday, and the stock market took a crash, and then the crypto market followed, and most of the gains have been wiped off. Bitcoin's currently standing at its lowest at 30. Last I checked was 34,000 something, and everything else obviously follows Bitcoin as well. There's huge losses everywhere. I'm also invested in crypto, but I don't do leverage products, and I always just do, and I'm not bothered. I know the projects I'm invested in, they're long-term projects, so the losses on paper, the gains are on paper until I actually cash them out. So I'm okay. I'm quite relaxed about it. I'm like, yeah, fine, whatever, we'll see. I think I see it as a buying opportunity. If I was more, I probably would end up buying a bit more. But that's because I have the knowledge and I have the know-how. I know what I'm doing. Be it stocks, and if anything, I'm going to go check the Tesla price and get some more Tesla shares because I love Tesla, by the way. But it's because I'm comfortable in the knowledge that I know what I'm doing. I'm not fretting and worrying about it. It's the long-term projects for me. But then that's where I have gained the financial literacy through hard work, by the way, and through sheer, tears because I have lost a lot of stuff. But now I know what I'm doing. I'm a bit more centered and secure. But we have to gain these insights. Hopefully not through the way I've done it, which is through, getting my wrist slapped every now and again, through mistakes, huge mistakes I've made at times. But, we have to gain knowledge on, on what to do. And what I think the first thing is we need to work out our risk and tolerance. When you say, so the first things we need to do when we are working on financial literacy is work out what is our risk and tolerance. What kind of money do we have in the bank? What kind of money can we lose? What kind of money are we prepared to lose? Sometimes our, financial on the paper, our risk and tolerance should be a lot higher than it is because we emotionally cannot deal with loss. Sometimes, as the case is with me, on paper, I'm not allowed to lose any money, but emotionally, hey, it's okay, I'll make it again. And I had that kind of attitude in the past, and I've lost it. I remember in the beginning when I used to make investments, I would never think that I'm going to make a profit. It was just, for some bizarre reason, there was no possibility I was ever going to make a loss because I'm such a genius at investments. I'm not. I found out the hard way. I'm not. And so I was too optimistic. I was too, I was too risky. So how, where and how can we assess our risk assessments? How do we work out where, risk tolerance, rather, I should say. And how does that come into financial literacy, and how is that important for us?
Well, I think that's a good topic to bring up, because diversification, with what most people think of is just the different risk classes that they own in their portfolio. Yeah. But in reality, diversification is so much more than just that. It's looking at how do you hedge your bank account? How do you hedge your real estate? How do you hedge your investments? And then, where are the opportunities? Because there's always opportunities in down markets. And we need to see what those opportunities are. But if you have liquidity or cash and we go into a down real estate market, could you buy something else? The answer is yes. Do we have all those rents that we're getting from our real estate? Do we have that in a separate account that really identifies that, so that if there's anything that happens with that property, we can take care of it? We don't have to get more debt on a credit card for it, or a line of credit against the equity. We can actually just take care of it ourselves. And so does that give us more opportunity to say, okay, we are just pulling these, incomes in, and we're showing it as its own entity, its own, resource, its own rate of return. But then if we go into the stock market, and this is what's been lost in the stock market, is that years ago, it used to be you put your initial investment in, and then when you have gains, you take those gains out and you put them in another pocket. What happens now is they're reinvesting of everything, and it actually starts to, increase. You have more units or more short shares and things of that nature. But as that kind of continues to go on in the future, when do you rebalance? So when I look at the stock market, we look at something called a risk graph. I want to know what the history of that stock or that purchase or that mutual fund or that strategy. I want to see what the history of losses were, because can losses repeat themselves? And if you don't understand what the losses look like in your investments, then you really don't understand risk, because of the fact that if the risk can happen again, and we can go down another 50%, is that within your gut? You had said something just a moment ago, saying that people cannot handle the emotional loss of losing anything. Yeah, I 100% agree with you. You could be the most aggressive investor or the most modest and mediocre investor. No one can ever stand the association of loss. They just don't like it. And you could be worth billions, and if you lost $1 billion overnight, it's like, oh my gosh. Some people can afford to lose, some people can't. But, and the people that really can't afford to lose are the ones that are getting closer to their 50s, and they're thinking about retirement finally, because it was part of their vocabulary early on, but they really weren't thinking about it. But they're going into so just like we said, even with the housing market, right? Since 2008, it took about 14 years for it to really push the lid off of where it was, in 2000, height of 2000, right?
It's taken that long, yeah.
So how many people have 14 years for something to recover?
And I think that's an important question to know. I think the risk, your risk tolerance does change with your age and what you're like, what you want out of life and what you're expecting to do. I think that's an important question to ask yourself. And these are hard questions because no one wants to say, well, actually, I'm 50, I can't risk that kind of thing. Or I'm 60, I'm not able to risk that kind of thing. Or, I'm not 35 anymore, so I don't have those 15 years to be able to recover like we did from 2008. I did that. I was one of the fortunate ones. I actually bought just in the peak of the last, the property boom. So I bought in 2006, end of 2006, throughout 2007, and until mid 2007, and the crash began in the end of 2007 and 2008. Everything was wiped out, and I suffered greatly. And I was going through a divorce at the same time, so it was just awful the same for me.
We're kind of aligned.
Yes,
we're kind of aligned.
It was awful, but I somehow through, I don't know if it's sheer luck or whatever have you, I managed to sail through with a really bad credit score to my name, but I managed to come out the other end. But it's the property that I bought in 2006 is still just about recovering now, which is shocking, for a property like that to be just recovering. Like, I am now out of negative equity just recently in the last couple of years, and which is astonishing, because it's taken that long.
That is astonishing. 16 years. Wow.
Yeah. So this is, because I have to say, I did make money on it from 2006 to 2007, but from 2007 it just went, So this is where we struggled substantially on it.
Well, and those experiences will actually navigate to even better financial decisions for you to make in the future. I mean, they just, you can't avoid that. And it's actually one of we've earned where we've been through to get to this place. And we need to thank those experiences because it made us who we are today. Agreed. But at the same time, it's still never fun. And, when we say the statement, losses hurt you more than gains help you, it's 100% true. So it's looking at, your risk future is your risk past. It's not just about the rate of return past is your rate of return future. It's the risk that you actually have for the past that's going to dictate what your risk future looks like. And that's how you need to start to diversify any financial decision that you're making so that it actually comes together and you're going, okay, if this goes down and this goes up, I'm going to be okay because I'm going to balance out. And am I going to recover quickly from it? Is 14 to 16 years a long time to recover? It's a long time to recover. And when we get closer and closer to those later years of life, we don't want to take on as much risk. Some people, I've met people in their 70s that take great risk. And I say you don't have to anymore. Why? You've gotten to this place where everybody else is trying to get. Why are you taking on more risk that you don't have to? And then that changes the entire dynamic of how the future, kind of unfolds. So many people want to slow down, but then they go, okay, gosh, I still have more creativity that I want to, give this world. And as we should, we just don't have to take uncalculated risk. If we actually knew what the losses look like of the future, it's really a different kind of crystal ball because all we have to do is look in the past. Yeah. And then we can actually make better decisions financially for every decision that you're making, from shoelaces to buying cars to, buying real estate to buying investments, and protecting your family ultimately is one of the best investments that you can make as well. So there's so much more, and I know that we only have so much time. So do you have any more questions for me? Because this has been a joy to be a part of your show.
I've got just a couple more questions, and that's more about, I think something we were talking just off camera beforehand, which is about planning for information and pension, and actually having those awkward conversations with yourself, with your spouse, with your partners, and especially your financial advisors. And most people that I know at the moment, including myself, I know I need to deal with it. I'll deal with it later. That later never comes. And it only came to my attention again when you were mentioning. I'm like, I've talked about pension planning, and I haven't set up a pension for myself, which is really, really stupid because of the properties and everything else I have. Yet it's something that, it's pushed to the side because other conversations, other tasks take priority. But how important is pension planning, and when do we stop?
Well, I want to talk to you from a standpoint in the United States, and there's been some tax law that's actually changed. So for the business owner that's looking to mitigate taxes, this is a big conversation for this. But also, if I have an individual that's not a business owner, we can create a pension-like income as well. And having guaranteed income to be able to accomplish your goals, to be able to accomplish your dreams, to be able to make sure that that cash flow is coming in. Why do people like real estate again? Because they get that monthly cash flow. But if someone stops paying their rent, the cash flow stops. So if we actually look at guaranteed resources that can create cash flow on a monthly basis every year for the rest of your life, that is a major peace of mind. It's a major peace of mind, because then you can actually have the cash flow to come in. Now, from a business owner standpoint, like when we are actually referred someone from a tax professional here, someone's coming to us and they said, okay, gosh, we made a lot of money last year. We think we're going to consistently make money every year thereafter. And okay, the whole goal was to make as much money as you possibly can, but to keep as much money as you possibly can too. This is a way that we can actually say, once the analysis is done and taxes look like they're going to be like X, if it's more than $100,000 going to the government and or state, we look at that and say, well, what if we can actually create what we call a defined benefit pension plan in the United States, where we can actually create bigger contributions going into a pension plan that actually stays on the business's balance sheets. So instead of giving it to the government allows us this ability as a business owner to put larger amounts of money that they would have normally sent to the government, but to put it into a pension for themselves. And that stays on the corporate balance sheet, and it stays there. And it's also an incentive for employees to want to stay on as well. Many, many years ago, starting back in the 40s, when Social Security was designed in the United States, the pensions were designed in the United States as well. Europe was a little bit closer to the game than the United States. So what we saw there was that people became very confident in working for that same company for 30 or 40 years.
Yes, of course.
Lifetime income for the rest of their life. Well, what has happened since the 1980s, when we have a 401k here, you have a different retirement system, but that 401k was designed so that corporations wouldn't have to put so much money away to have a lifetime income for their person that's retired anymore. So 100% of the responsibility went on to the consumer. So if you weren't putting money in the 401k, you weren't going to get any kind of pension like income. And really 401ks don't necessarily do that on their own. So how do we actually kind of reverse this knowledge and say, okay, I'm a small business owner. I have a pension for my business, for my practice, for my employees. They all get to participate in it from my contributions, and I'm able to have longevity with them, even more so, more loyalty, because they know I'm actually doing something for their future. And it's all part of the process of how we actually get to, if the government's going to allow me to do something, I should probably think about doing it. And as a business owner, is it smart? Is it prudent to do that? I would much rather write a bigger check to my pension than a bigger check to the government.
Agreed.
Not that the government doesn't need the money, but the fact of the matter is my people and myself need the money more. Agreed. And my company balance sheet, reflects that. So business owners don't realize that there's more than just offering a 401k for their employees. There's a bigger way that they can actually put more monies aside and create more abundance, not only for their employees, but also for them for a lifetime ahead. And why not use the government's money to do that? Why not? It's there for our ability to do it. And it's a responsibility that we have, I think, to the people that we're so fortunate that we have work for us, that we can actually give them something great to consider for the future, as well as ourselves. Because if we didn't have the money, we just keep writing the checks to the government. What's the point of creating a profit? What's the point of being a business owner? What's the point about being capitalistic? We want to be able to keep as much money as we've possibly earned as well.
Agreed. I think so. So basically, my understanding is, one, go and speak to a financial advisor about what's the best route for you to save and work on your pension, depending on your location. And we have, obviously we have different rules for being in the UK, but I think we have something similar here as well. From what I remember from my accountant last telling me, that we can, instead of paying myself a salary, tax-free, they can take a certain amount and pay towards my pension. So it's something similar here as well. I remember that the accountant mentioning it to me and highly encouraging me to set up a pension fund already, which I haven't. So I need to do that. But absolutely. And so I think these are conversations that you need to be having with the financial advisor, which also means that as soon as you start working, it doesn't matter where you are, and it doesn't matter how old you are now, by the way. So you could be 35, you could be 50, you could be 65, you could be 70, it doesn't matter where you are. You do need to go and seek professional advice. You need to speak to a financial advisor, explain to them where you are, and then find a way to get to where you want to be in 10, 15, 20, 30, whatever years time. And pension, especially when you're younger, the younger you are, the earlier this conversation you have, the better it is for you, because you can plan better, you can be more tax efficient from what I understand, but both the US and the UK. And you can actually have more peace of mind that you will have something to fall back on when you are older. And you're not able to do the crazy 80, 100, 90, 100 hours that you're doing at the moment in your the professional job. I remember doing crazy hours when I was working as a lawyer, and I'm not doing such crazy hours at the moment, but at times it feels like it, because when we're launching a product, I am doing crazy hours and there again. So which I can't imagine doing that when I'm 60. So you have to be realistic and be more pragmatic about what you need to do and what you can expect yourself to do and achieve. But you still have to maintain a certain type of lifestyle, certain standard of lifestyle. And then you have to plan for that now. And this is where, and speaking to a financial advisor, I think it becomes paramount. Okay, so on that note, I think we're going to wrap up. Tell us, Elisabeth, how can we connect to you? Where can we find you on the internet?
So my name is Elisabeth, and it's spelled with an S, so very much like the European way of spelling it. So it's elisabethdawson.com. You can check me out there. You can also go to, again, about the book. If you want to get a free copy of the book, there is actually a website called wealthbydesignbook.com. It actually has a financial planning companion course, so you can actually see, what your numbers look like currently right now and into the future. But the main purpose of why I'm doing this is because I want people to be able to have that education, that literacy that's not taught in school, that's not taught through life or society. And so you can feel more empowered that your outcome in your financial world is going to be far greater than maybe your neighbor or someone else that didn't get that knowledge. So I think what we'll give you is, we have these great little bookmarks here, and there's a little QR code. I don't know if you can see that too well, but if you can, if not, we'll make sure that Gull has a copy of that so she can put it in the listing with all these things too. We'd love to get your feedback. We'd love to educate the world. And again, it's my mission, my passion, my purpose is to educate as many people possible while I have breath in my lungs to make sure that everybody has a better relationship with money, and that with all the abundance that Gull is going to create with you, that we can actually put that money to work so you can actually have it for a lifetime versus just something that you came and got and then it disappeared. So make as much money as you can, keep it, and we'll help you.
Fantastic. Thank you so much, Elisabeth. So all the links, if you're listening to us on the podcast, the links that Elisabeth just mentioned will be in the show notes. And if you're watching us on YouTube, then down below in the description section, we'll have all the links that Elisabeth just mentioned. Go check it out. Do go check out the book. I think it's amazing. It sounds amazing. And I really do think that you need to be seriously thinking about financial literacy for yourself, about how you can plan your financial future today, tomorrow, and for the coming tomorrow as well. If you don't have family yet, it doesn't matter. You will have family in the coming nearer future or something. And you need to plan for it. And I think these are quite important topics to think about. They're hard, they're difficult. I know this for personally, that you don't want to think about them, but they are an important topic. And I think for that reason, today's episode has been very, very important for myself. And I'm sure for most of you listening out there. But on that note, thank you so much, Elisabeth, for sharing your knowledge with us, for sharing your expertise and bringing some very important topics to our attention.
Well, thank you so much. And again, I'll just make a final comment. Procrastination is not an option, because that's not what will create success for you. So don't procrastinate anymore, Gull.
Thank you so much, Elisabeth. Thank you.
You're welcome.
And thank you for listening to me and Elisabeth today on our Money Talkies segment. I will be back with another amazing guest, asking them for nuggets of information and asking them for advice how you and I can build a better business so that we can attract more abundance into our life. Until the next time we meet, this is Gull Khan signing off. Take care and bye for now.